Hey everyone, Andrew here. Welcome to our Markets in Turmoil special. No, it's not Markets in Turmoil. The market's going through a bit of a correction, but it is important to do these video updates when the market's doing well and when it's doing poorly because that's when people need this guidance the most. I'm also going to talk about my MSOS cannabis trades and what I'm doing with those and how I am thinking about them. So let's dive right in. At a very high level, if we look at all of these US indices, we can see that they are all drawing down from their highs. And looking at the S&P 500 and the Nasdaq, they are trading inside of their respective monthly value areas. The bearish 80% rule has triggered, as you can tell by this shading, and we're now cascading below the 50-day simple moving average on both the S&P 500 and the Nasdaq. The Russell 2000, which is small caps, is pretty much doing a backflip off the balcony. We're trading below the monthly value area and we're below all those key moving averages. So let's jump into our Discord and we're going to go to the pre-market notes that I wrote this morning. This Andrew analysis chat is the closest thing that we have to a private Twitter feed. So if you're ever wondering what is Andrew thinking about the market today, you can always jump in here. I put all of my pre-market homework in this channel and I always cap things off with these pre-market notes. So as we wrote in here, the market's struggling on a few fronts, and I put 6 bullet points in here. So let's tackle the first one, which is the unprecedented government shutdown. And we're going to jump right over to Poly Market to do that. I've been watching this like a hawk. So if we look at these government shutdown odds, they've been moving all over the place. And as of right now, there's a 59% chance that this government shutdown is going to extend beyond November 16th. So does that mean the market is going to be reopened by Thanksgiving? We have no idea. By Christmas, we have no idea. And we know that the market hates uncertainty. We're starting to see this government shutdown. It's actually impacting the short term funding markets. We're seeing it's impacting SNAP benefits. We're seeing now it's impacting airline flights as well. So it's just never a good thing when you get something that is unprecedented and investors really just have no visibility on when this is going to resolve. In my view, this is a self inflicted wound. And this is really the first thing. Like, if this correction is going to end, it's going to likely coincide with the government reopening and getting much more clarity on what is going on here. So let's now dive into these other macro drivers. So we have a slowing US jobs market. The title of last night's newsletter was, the biggest job cuts in 20 years. And 20 years is a very long time. A lot of these job cuts, they're happening in the corporate sector. Maybe they have something to do with AI, but it's definitely not a good thing to see the job market softening. That really just reduces confidence in the US economy and really just investor confidence as well when they see that happening. Then you top this off, in addition to a weakening labor market, we have stubbornly high inflation. And the gauge that I watch very closely, that I include in every nightly newsletter, is this trueflation gauge. And you can see here we're hovering at around 2.54. In a perfect world, we would want to see trueflation that's just completely in a downtrend, right? Especially when we're seeing this economic softness. But we're not seeing a downtrend. We're actually seeing trueflation, although it's dipping on the day. We're seeing, arguably this is actually trending higher. So if you have slow growth and then inflation trending higher, that's the exact opposite of what you want to see. And then when you add in number 4, which is the increasingly high US debt burden. So with that debt burden, we're currently in a debt snowball where the US economy, we're adding like $1 trillion in debt, like every couple months now. It's really unprecedented. So to have these big government deficits, and even while the US stock market is booming and everything was going incredibly well, we have this AI build out, but yeah, we're just tacking on more and more debt and taking on a higher and higher interest burden. That's not good. And I think the worst case scenario is you get softness in the US economy that would most of the time coincide with lower bond yields. But because we're just taking on more and more debt year after year after year, if there's just much more supply of US debt, then that could really impact long-term bond yields, where those long-term bond yields, they might just be stubbornly high. So even like TLT, for example, you would expect if the market's getting really weak, TLT long-term treasury should be like super bid, maybe they're making new highs, but long-term treasuries, they had a downdraft and now they're just consolidating sideways, even though we're seeing that, there's pretty big weakness in the labor market. So just from a macro standpoint, there are definitely some headwinds. And even if you think about economic growth, a lot of that growth was coming from this AI build out and all of the capex spending by the Elite Eight stocks. So if you strip that out, the economic growth is probably a lot worse. And then, yeah, going into that AI spending, it's now becoming a little bit more questionable. So, for example, Tesla just announced that, hey, we have an awesome AI chip that we're going to be using for our AI processes and our robotics build out and all that good stuff. So that is potentially less demand for NVIDIA chips. We also saw that Google, they just announced that, hey, they have a chip. And we saw Anthropic committed to buying a ton of their TPUs. So essentially, what happens in just the world of business in general is NVIDIA has these awesome profit margins on these chips. And when these other companies see that, they go, man, if only we could just reduce our reliance on NVIDIA. Maybe we could start selling chips or at least just not have to purchase as many as ourselves. That would be awesome. So now we're starting to see that happen. And then on top of that, you just add that we had some really bullish investor positioning in the market. And I believe I shared that, it was probably yesterday in the morning in this channel. Yeah, CTAs are sellers. CTAs remain heavily long equities. And we know that when these trend following strategies have these significant long positions, they can be forced to liquidate when the headline indices are below all of these key moving averages. And what we're seeing is, yeah, the S&P 500, now we're trading below the 20-day simple moving average. So let's jump right over to it. Oh, you can see a little bit bigger. And yeah, we're trading below all the key moving averages. That's when these players could really start to liquidate. And then you got the trend following strategies. You also have the volatility control funds that they add more exposure the less volatile the market is, and they reduce exposure the more volatile the market is. And now we're seeing the VIX, it's going all the way up to above 20 now. So now those funds could end up being triggers. Then you add in retail investors. We saw interactive brokers say that there is massive length in terms of margin debt. We know a lot of retail investors have been making tons of money in the market, and those players could become forced sellers as well. So when you've got all these pieces that are just playing now together in unison, it creates a tough market environment. And I would just make sure, keep monitoring NVIDIA. In my opinion, this is the most important stock in the market. Now it's breaking below the 50-day simple moving average. So we're really seeing the momentum is breaking in the market. And I think what's pretty unique about this situation is we have a government shutdown going on. And I could see a lot of investors going, why would I sell? I'll sell and then the government will reopen and the market will rebound. And why am I going to do that? And that is creating the conditions for this capitulation that we're seeing, where no one wants to sell, but then as nothing is resolved, then the market trends a little bit lower. And now we're starting to see it looks like players are being forced to sell and they're getting kicked out of their positions. Now, going over to our heat map, we can see the trend model is at a -3. Breadth is only mixed today. So that's a key right there. So if we go over to our US equity indices section, the RSP, which is the S&P 500 equal weight index, is not even really trading down on the day. It's only down 0.08%. So to me, we see the semiconductors are getting hit really hard. We already saw Nvidia was down bigly. And so that's telling me that there's some air coming out of the semiconductors group